this is a panel that focuses attention really on what is a cryptocurrency, what are the principal properties or components of the cryptocurrency. How can we possibly think about a framework that will allow us to analyze better those kind of instruments or units? One of the big questions, of course, that was raised in the keynote address here was what would be perhaps the institutional services required to support such a currency. We did not touch upon those issues. And what is the technology behind that? I think this is something that we need to understand. We understand that this disruptive technology, but how does it work and what is the future of that? And at the end, I think Christine mentioned that this must be different individuals than those that own the bus, those that they use bitcoins and cryptocurrencies. Do we have any empirical evidence as to what is the profile of a typical individual from a good case study or a good analytical work that has been done recently? And indeed we do. We have a member of the panel who has done work in Canada. And then at the end, what are the startups? How it is shaping up to have a startup working on the crypto. These are some of the questions that will be addressed in this panel, and I would like to invite, first of all, David. You can read his bio in your agenda booklet, and we very much appreciate his participation today. So the approach is that for 10 minutes, each every one of the members of the panel will present his or her views about those topics that I raised, and then at the end we will have an interactive discussion. Thank you.
Thanks. Should be okay, I think. So thanks for having me. There should be a Fed disclaimer in here. I know I had it. So even though it's not there, it's still there. So just keep that in mind. Maybe I'm just stating the obvious here. But what I thought I would do today, since we're in the early part of the program, was sort of level set a little bit and try to provide a bit of a simple framework around what we mean by cryptocurrencies. It comes back from my background as a monetary theorist, as well as a payments policy expert at the Federal Reserve. And obviously as a monetary theorist, I've been following Bitcoin from fairly early days because it piqued my academic interests. And little did I know that it would start to consume my life from a policy perspective as well. But for a typical academic style central banker, when research and policy combine, this is a home run in some context. So there's the disclaimer. All right, so there it is. Looks like we're a little bit off kilter. Is this going to go the whole way? That looks like it. Okay. So we'll just make do with what happened here. So if there's nothing else to take away from the presentation I have here, I think this first half of the slide and the second half of the first half of the second slide are three things. Okay. The first is that cryptocurrencies would have three basic properties or components to think about. The first, and Christine talked a lot about this, is sort of the asset properties or the unit of value properties of a cryptocurrency. So I think of them as the money or the currency piece. I think later on we'll have a bit of a discussion about what we think this asset actually is or might look like from a variety of different perspectives. For me, as an economist and a monetary theorist, I think of it first and foremost as money, and I'll explain why in a minute. The second, way up there, is the process through which, the second component is the process through which value is transferred. And these are the payments system-like properties, okay? So this is so behind all these cryptocurrencies is a computer-focused transfer mechanism that ultimately allows the transfer of these units of value through non-traditional ways, more through a peer-to-peer network rather than the traditional hub-and-spoke financial system. So there's some interesting elements to talk about there. And then the third main component is that there are a variety of institutions that emerge that support their use. So the financial institution-like properties. So in the case of cryptocurrencies, we see a lot of non-bank or non-traditional financial actors emerging in the space playing key roles, whether they're exchanges, wallet providers, or some other type of provider as well. Okay. So, moving to slide 3, which is really bottom of slide 2, we'll talk a little bit about what we mean by cryptocurrencies having some money-like properties. And you've probably, if you've been following this industry a lot, you've seen maybe a few speeches by central bank governors and things that like to talk about the 3 functions of money. The means of payment, the store of value, and the unit of account. So what we mean by each of these things is really, folks are asking the question, what is the asset-like properties, and is this really money? And so a lot of the discussion is whether or not, if this is a money, really kind of ties to the fact whether it's being used for transfers, for payments, whether it has some store of value properties that we can hold it and be able to leverage its value over time. And then finally, its unit of account, which do we see prices of goods and services being posted for being posted in Bitcoin or other types of cryptocurrencies. Now, of course, I think the main consensus is that, at least from a holistic point of view, from a ubiquitous or universal point of view, cryptocurrencies don't really meet these properties at this particular point in time. There are limited uses of it as a means of payment, and very limited uses for Bitcoin, although there are some potential uses. It doesn't necessarily serve as a great store of value, as we see from Christine's presentation. There's a lot of volatility, so it does serve as a store of value, but it may not be the safest store of value. And we don't often see, except in some limited circumstances, prices being quoted in things like Bitcoin. I think the common example is Overstock.com would post prices in Bitcoin for those who are interested, but you don't necessarily see that in a lot of places. So that's why some people will refer to cryptocurrencies with a new language of crypto assets, which is a bit more generic term. Okay, but the real issue when we think about this question of is it an asset, is it a money, ultimately comes down to how the supply of this money is managed. And this is where some of the cryptocurrency innovation might be. Rather than relying on an institution like a central bank or even private banks and other examples throughout history, you really rely on the supply of money being managed by a computer algorithm. Okay, in the case of Bitcoin, the stock of money is, the long run stock of money is fixed. It grows asymptotically to that fixed point over a long horizon through a certain channel, and people can understand and know that. Now, why is that important? Well, there's oftentimes in monetary economics and monetary theory a lot of debate about how supply of money is managed and whether or not the gold standard is good versus a more discretionary view of the central banks typically adhere to. So these debates kind of got reintroduced through the emergence of things like these cryptocurrencies, because you could think about money management in a different way. Whether it's good or not, I'll let the general public try to decide. But it certainly is different, and the technology has allowed some of this capability to take place. The key point about this is that I want to mention is that trust is an important component, because money in and of itself, and these assets, these cryptocurrency in and of themselves, have no intrinsic value, right? I have a hard time thinking of them as a commodity from a conceptual point of view, because commodities generally, to me, have some consumption value or something else that has an intrinsic value. Money, on the other hand, solely gets its value through transactions. And the transactions value comes from a combination of people's beliefs that you can transact with it in the future, therefore it's safe to hold it and use it down the road. And ultimately, based on the trust that you might have in either institutions, or in this case, the computer algorithm, to manage the supply of money effectively. Okay, so that's all I'll say about that. The second big thing is now thinking about it from a payments perspective. So now thinking about the transfer mechanism. So Bitcoin essentially does this without the need for trust in individuals or institutions, right? And many of the crypto assets operate this way as well. And so ultimately, payments require some initiation by the sender. So that is that the person who is sending the payment is is the actual owner. There should be an authorization of the transaction that checks that that owner is in fact the true owner, and that there's sufficient value in the account that you have enough Bitcoin, for example, to transfer from me to say Mike over here. There's clearing where there's information that's being transferred to help ultimately execute the transfer of the value, and then finally the settlement is the actual transfer. Okay. So the traditional financial system does this through trusted intermediaries, again, through, you access your bank account, there are checks through the authorization process that banks will do to sort of verify that you in fact are the owner of that account. They'll check to see that you have the actual resources and funds to make the transfer. They communicate with your receiver's bank and things go from there. Cryptocurrencies don't do it at all like that. Let me see. Oh, sorry, my slides are confusing me. So cryptocurrencies will do this through this transfer mechanism. Is completely different. It actually has just an automated process of checks and balances where I don't necessarily know who's doing the checks and balances, right? But I ultimately have to trust that the transfer mechanism itself works in such a way that I don't have to know who's helping validate the transactions and moving the funds ultimately for me through this automated system, right? So that's a kind of a key difference about when we think about cryptocurrencies and disintermediation. A lot of it is thinking about this transfer process, not so much the asset process. So both of these things are interesting to be thinking about, mostly because you can think of this same transfer process not using Bitcoin, but using US dollars, right? Or using securities in a broader financial setting. And in fact, that's a lot of what the private sector has been doing, is thinking about this type of transfer mechanism outside of the reliance on a crypto asset, but putting more traditional assets in their place and thinking about how this technology might change the financial structure even without some of the pains associated with cryptocurrencies. Okay. So just to move on, some of the things that central bankers often care about from this transfer mechanism point of view is to think about how does it impact certain payment system risks. So a couple that I'll just highlight here mostly hinge on operations and operational risks. So are there additional security risks when things go wrong? How do we understand reconciliation of transactions when somebody actually made a mistake in inputting the information? How do we think about cyber attacks? Is information secure? All right, so things like this are very important. One of the big things I'd highlight about cryptocurrencies is that there's a lot of uncertainty about governance. And governance structure is a big deal when it comes to actual transfers of payments, particularly when you get to large value types of payments. Governance is going to be very important from a financial stability point of view, but it's also important from just a soundness point of view for trust in the system. And oftentimes with cryptocurrencies, we have more of a Silicon Valley type of governance structure, which works for open source applications, but in financial markets, it raises a lot of additional questions in terms of signing liability for things like that.
Right back to the last people say, talk about use value. I think there's an additional risk if that use value should be compromised. Say, for instance, if people are valuing it for privacy, and that goes away. Right? So I don't know if that fits into any of your categories.
So the value of privacy?
Value, I'm saying use value, maybe one of the big use values is privacy.
Sure.
Privacy can be compromised and then the use value is gone. Right? So that is a real value. I'm not sure if it fits into one.
Yeah, I think about the privacy component is part of the it's tied to transactions value. The fact that I want to transact, but transact confidentially or privately. is part of that. But I think it generates from the transactions. But yeah, I don't disagree. I mean, there's trade-offs with that, which I'll get to in a moment. Okay, so it's one thing I want to point out is it's awfully challenging for a cryptocurrency to become a means of payment because it must compete against cash and other types of more traditional payment systems. So in a country like the US, where we have some relatively robust payment systems, okay, it may be hard to break a barrier of entry because of high network scale and other types of fixed costs that are associated with payments, because you need a number of users to really make the value of something like a cryptocurrency have sustainability over time. All right, so it really requires a critical mass of users to buy and sell and to transact with in order to really be thought of more seriously as a payment system. And that's where you have to start thinking a little bit about the cost of such a system relative to other alternatives to achieve it, whether it's card payments or cash or other types of more modern payments initiatives like we're doing with the Fed and with the private sector, is thinking a bit about ways to modernize the US payment system, not necessarily through something like a cryptocurrency. Okay. So then the final point I might make here is a little bit about the additional institutional services that support cryptocurrency. So it's ironic, Bitcoin has often been touted as a way to disintermediate and rely less on institutions. I think that works well if you're a computer programmer. It hasn't worked so well if you're just an everyday person. Ultimately, if you're going to access this, you access this through intermediaries. And these intermediaries, as I mentioned earlier, are exchanges or wallet providers, folks with GUI interfaces for your phone. These sorts of things make it all a little bit more tractable for an everyday user. So it's a bit ironic that we start to see the emergence of intermediaries kind of try to provide services for everyday use. And so I think it's important to point out that those types of intermediaries are emerging. The thing is, they're not necessarily traditional. So they're not necessarily the traditional banking sector. They're not necessarily folks with the same type of expertise in the financial markets, but they may be still playing similar types of roles. I think the question was, are these types of entities regulated? I think in the U.S. the answer, for U.S. entities, the answer is yes, that they're regulated by state financial regulators. So they are what were often called money transmitters. Money transmitters also include entities like PayPal and some others that are not necessarily banks, but do hold money and transfer money for individuals. And the traditional regulatory architecture for that in the U.S. is actually at the individual state levels. So entities like PayPal and some of these wallet providers go out and try to get 48 different money transmitter licenses to conduct business in the various states in the U.S. So that regulatory structure is generally micro-prudential in nature, with consumer protections as part of that, as well as just general prudential holdings for funds, if you hold funds and things like that. These aren't traditional banks in the sense that they make loans, but they do sort of serve more of what I might call a narrow bank, where they may hold funds for individuals that are fully backed by something, but not necessarily take on the traditional bank. So they are regulated, but they aren't regulated in the same way. Is probably where I end up. So maybe the following, here I'm out of time. So one thing I try to do is to pull it all together, and I'll try to get better slides for this, for the packet. Is you can think about these three dimensions in a variety of different ways. Cryptocurrencies tend to be this last line, no issuer at all, okay? But they use a technology like distributed ledger or blockchain, all right? So this disintermediated computer algorithm, right? And the institutions typically tend to be non-financial institutions. But you can think of this technology, for example, like distributed ledger technology, being used in other contexts where you do have issuers, and these issuers could be trusted entities whether they're central banks, private banks, or other private non-banks that play some kind of role that might use the technology, etc. So that's, I think, my initial set of thoughts for now, and I'll turn it over.
Thank you very much. We appreciate it, David. Then we are moving right away to blockchain and token economics from Will. And Will has tremendous experience in measuring and usage of cash. So let's go directly to the next.
Very good morning, everyone. Today I'm just going to talk about two kind of research themes or agenda related to blockchain and cryptocurrencies. So there's a plethora of definitions or media discussion on these concepts: altcoins, tokens, blockchain smart contracts. So I think the first question is we want to develop a kind of consensus framework for this technology, which is the technology behind cryptocurrencies. So that's kind of the first line of research. What exactly is blockchain? How does it work? I'm going to go into more details in a little bit, but I'm going to argue that the main function, the core function of blockchain is to provide decentralized consensus. And with that in mind, we can talk about protocol designs. We can talk about, given a design of the protocol, how the market is going to evolve, or how the community of miners and users are going to adjust over time. So that's one line of research. The second line is, once we take this core functionality as given, what are the implications on the real economy in terms of competition in the market, in terms of trade finance, auditing and accounting issues? And I think one important question to keep in mind is, what exactly is new? Is there new economics, or this is just relabeling with a new technology? Right? So starting with what is blockchain, right? Well, we all know societies and economies need consensus to function. We need consensus to write contracts, right? But it's typically provided by centralized parties, such as governments, courts, third-party business arbitrators. And sometimes they are criticized for being a little bit fragile or expensive. Now, blockchain technology is really trying to provide this consensus in a decentralized way. And the advocates for blockchain technology would argue there are at least two advantages to providing decentralized consensus. Number one, we can prevent single points of failure, broadly interpreted. Right? So we don't worry about one particular intermediary having issues leaking private data or having a technical failure that causes the entire system to break down. Now, the second one is, by being more decentralized, and here decentralization doesn't mean full decentralization, just more decentralized than traditional organizations, there could be potentially less rent or market power by intermediaries or new forms of intermediaries, and that could benefit consumers. Right? So, but providing this decentralized consensus is not a free lunch. There are costs involved in this process. And I personally view the true innovation of Nakamoto and the advent of Bitcoin as it really lies combining this monetary incentives with the consensus generation process. Because from earlier research, we already know how to generate consensus. If you're familiar with Paxos and the earlier work in the 70s and 80s, we also know there are digital cash that was introduced earlier. It's really combining the two and using digital cash to provide the right incentives to generate this decentralized consensus. That's really innovative, in my opinion. But there are limitations to this. Well, if you look at the energy consumption of Bitcoin, is comparable to Hungary, which is 57th largest energy consumption in terms of annual amount of energy used. So it's very costly, which is not channeled into socially useful purposes, right? Just pure competition, tournament. there are legal challenges. Today I'm going to touch on the risk sharing as a centralizing force in this supposedly decentralized system, as well as information issues. Some of you raised privacy concerns in this environment, which is very much a serious issue. So I'll start with the information channel and how what kind of impact it has on industrial organization. So in this study, we actually titled Blockchain Disruption Smart Contract, actually show that decentralization can increase the effectiveness of consensus, which is not too surprising. And with that, we can use smart contracts in some situations to improve contracting or enlarge contracting contingencies, such as whether a good is delivered successfully with the, if I'm delivering wine, whether it's shipped with the right temperature and all that. If we can reach decentralized consensus on that, you could imagine we can use smart contracts to encourage entry and increase competition for this industry. Now, on the other hand, to generate this decentralized consensus, we have to distribute more information. Even encrypted data are data. So if we want to make it more decentralized, we're going to distribute more information. So firstly, there's privacy concerns. And secondly, with more information distribution, there could potentially be greater collusion, as we know from earlier research in industrial organization. And here are just a couple central bank research reports recognizing this key issue of information distribution. I believe the slides will be posted online, so I'm not going to read over them. And this is also mentioned in Financial Times. The technology could potentially lead to greater collusion, and that's what we were looking at in this paper. And in the paper, also give a number of concrete applications of the technology. But here, in the interest of time, I'm just going to go very quickly on these few topics. Now, in addition to information distribution, now we're shifting here. We're going to talk about another centralizing force, which is risk sharing. What I show you here is, on the vertical axis, is basically 100% of all the hash rate computation power devoted to Bitcoin mining. Horizontal axis is from 2011 to 2018, how the whole thing has, the total computation power has increased quite a bit, as indicated by this red line here. And all these different colors are basically different mining pools. So mining or maintaining decentralized consensus in this environment is a risky business. And for risk-averse agents, naturally we're going to pool together to share risk. So there's a risk-sharing channel which limits decentralization. And the idea is just, if we have a bigger pool, which is getting closer to 51%, and if you're familiar with proof of work, that could lead to instability of the system, a failure of the system. However, what we find is there are also natural countervailing forces. One of them is just this simple idea of diversification. We teach that to students in business school all the time. So rather than having to join the biggest pool, mining pool, I could diversify across smaller pools. As long as their total computation power or total size is large enough, I enjoy the risk-sharing benefit as a miner. So in that sense, I don't have to always increase the largest pool or join the largest pool. And also, the largest pools tend to charge higher fees, which naturally limits their growth relative to smaller pools. So the two implications falling out of the study will be larger pools relative to smaller mining pools will grow slower, and that's what we see from using Bitcoin data. And also larger pools are going to charge higher fees, and that's also something we empirically test. We find consistent evidence for this theory. Now comes the cryptocurrency part. The earlier discussion was more on the technology behind it. So how should we think about valuing cryptocurrencies? I don't claim I can value it. I'll make an attempt here. So what are these cryptocurrencies and tokens? I'm going to argue that most of them are used as means of payment or media of exchange, according to their white paper. Right? Some are attached to certain functionalities, and the most funny one is Spank Chain, which is for adult entertainment. But Bitcoin is just for payments. There are other tokens used for other purposes on the network or on the platform. Two key features for all these cryptocurrencies or tokens are, number one, they are used as means of payments on these platforms, sometimes required, sometimes preferred means of payments. In the case of Ripple, for international payments, you can use other currencies to settle the transfers and payments, but using Ripples would be slightly easier. So that's one. Number two, there's always network externality. The more people are using it, the higher surplus or utility they get from using it. Right? So I want to incorporate these two into the valuation of tokens and cryptocurrencies. And the key idea is very much similar to issuing domestic currency. Right? If you think about US, how do we value the domestic currency? Well, if I'm current generation kind of entrepreneurs in the country, I know I kind of have to use US to make my business function. So that's the required means of payment part. And typically without a currency, if we are just using, say, Japanese yen or euros, it's hard for me to internalize the positive externality I generate for the country for future generations. But if we're using US currency and for a moment, assume we're fixing the supply of the domestic currency, then I know if I work hard today, the country is going to be more attractive for future entrepreneurs and immigrants from the globe, around the globe. They're going to demand more the currency. That means the currency is going to appreciate in value. So in addition to means of payments, it naturally helps us to capitalize the growth of future network of the system. And that leads to its value as a store of value. So that's what we mean by that. And that would encourage current entrepreneurs to be more active and do more business. And that could accelerate technological development for the platform, for the network. So there's a positive feedback loop to help us to price it. So in this study, I'll just quickly outline what is exogenous is a technology process that follows a stochastic process. The technology is indicated by DA. Now the price of the token is going to be endogenous, but in equilibrium, it's also a stochastic process. So all these drifts and diffusion terms are endogenous. And here is the coin pricing formula that we have. AT is related to technology, and bar is related to coin supply. NT is user base, so it's very natural. We have all this valuation, at least we teach in business school that for early startups, the user base is a key ratio that we look at. Beta is just production function parameter, and here mu t p is the expected price appreciation of drift. That's endogenously determined. But we can solve the equation. Basically, this Cong formula is just a second order ordinary differential equation, so we can actually solve it. How can this be used to price tokens? Is this just a theoretical abstract construct? There's some usefulness to it. It's hard to figure out what AT is in general, but to the extent that we're talking about a technology that's common across multiple platforms or multiple currencies, we can take that as given. This last term is just related to users' surplus or utility on the platform. So we can do cross-sectional analysis or pricing of coins, basically using the number of users as well as this endogenous determined price appreciation drift or rate to price the cross-section of tokens, having similar technology of serving similar purposes. So here is my plot of the adoption dynamics against the technology progress. So as we can see, with coin versus without coin, we're going to accelerate the development. And there's an additional function of token, which is to moderate the volatility of the network adoption. So with coins, we actually have a lower volatility in terms of adoption. I'll just wrap up the presentation with a last word on this, the initial coin offering role of these tokens. So from earlier discussion, you can already tell that tokens of platform cryptocurrencies can accelerate the development. They can help incentivize early contributors, especially dispersed contributors, to bring the technology to a good initial start and let it evolve even beyond the initial founding team. Right? With the protocols, the platform could survive beyond the initial founding team. But the downside is, we're really talking about early startups. So the red benchmark, as Christine was saying, maybe it's not IPO. It's really about VC and angel investors. VC and angel investors are more sophisticated. But if you're issuing the token to disperse investors, it's hard to separate lemons from really good projects. And typically with IPO, we can use retention of shares to signal the quality of the project. But here, because tokens are very liquid, since the early stage, there's limited signaling capacity. So that means there's greater pooling. There could be more fraudulent projects pooled with good projects. So that's an issue. And finally, I haven't talked about speculative bubbles, but that's something people are very curious about. That's what we see empirically. What I've given you is a fundamental theoretical valuation formula, right? And we're not relying on coordination, but there could be coordination issues, and many practitioners are actively researching into stable Congs, which would help deal with this volatility issue. Sorry for running.
Thank you very much. Appreciate it. I think these are well taken, but the question is, who are those individuals that are using Bitcoins, and at the same time, is there a future in Bitcoins? And I think this is the subject of Kim's presentation. Thank you.
Thanks for this opportunity to present this research. I work in the currency department of the Bank of Canada, so I feel like a dinosaur. So the meteorite is coming, and so I tell my colleagues we should learn to adapt. Yes, so that was part of the adaptation. So maybe we make it electronic at some point. So everything I say here is my views and not the views of the Bank of Canada. So another thing is I sometimes feel like the governor, he likes Star Trek a lot. So he's like Captain Picard. I feel like, the ensign and the engineering, he calls it out. I need some more information. So I need to know who is using Bitcoin in Canada. So this is a survey that we've been conducting for a couple of years now. It started off as a very fun thing, and then got more serious. So I guess I should be more serious. So here's a graph to put things into perspective, just to see how does Bitcoin fit in with all the other assets up there. So you can see it's the smallest one, but if anything, it has the potential to become very large. So I tell the story that this is the power pack in Pac-Man. Do you remember playing Pac-Man? And you need Pac-Man to become bigger and eat everything. So at some point, that's what the governor is worried about. If someone bites into that Bitcoin and becomes very large, it eats up all these other markets. So that's why I'm here to do this empirical research, because we care about demand for banknotes, and so if digital currencies come in, will it reduce the demand for banknotes? And then the bigger high-level question is, should central banks issue their own digital currencies? But on the other hand, when we discuss currencies, cash has this great feature that it's anonymous. And Bitcoin, because it's electronic, is pseudo-anonymous. So in order to do this enumeration, it's a hard thing to do, especially when people who usually use Bitcoin for transactional purposes, they value coins. So how do we go about this? So again, there is some empirical work in this, and I would want to give credit to Scott Shu and Anna Scheid, who were formerly at the Boston Fed. They were kind of pioneers, and they said, you know what, we're going to stick some questions in about into our very large survey at the Boston Fed, and they found that about 2% of the U.S. population have Bitcoin and use it. So we just like to talk to Scott and Oz, and they encouraged us, well, why don't you guys do a survey too? And we did that. And then, so the first one was in 2016, and we found it was like 2.9% for consumers. We also did a merchant survey. We found that there's about 1% of merchants that accept Bitcoin. And then Nicole Jonker of the Dutch National Bank, she found that there's about 2% merchant acceptance of cryptocurrencies in the Netherlands. So there's some work on transactions. In terms of empirical evidence about the store value, it hasn't been not that much. with the exception, well, that I know of, is this paper by my colleague Martin Van Orten, Local Code, where they impose a model-based approach, where they look at they have the quantity theory money, and they built in that's a nice fun. Then they take a two-sided markets approach, where they can decompose the transaction demand versus the store value demand for Bitcoin. And using this model, they can decompose the price and see how much of that price variation is due to transactions and how much is it due to store value. So if you look at transactions, this is the gray line, right? It's very small compared to what the overall price is. So therefore, in their model-based approach, they would say this is the residual or the store value. So in the absence of data, they can't really say that much other than using this model. So you have to believe the model in order to take that estimate seriously. So we try to do this, and we've done this now, I guess 2 times. First in 2016, first respondents were 12,000. And then we decided to do 1 month later in 2016, and then in 2017, with the run-up in prices, we got more money because people were more interested. So the methodology we use is very simple. It's an online survey. It takes you less than 5 minutes to do. When we got some of the numbers in wave 1, we didn't really believe it, so we put in objective knowledge questions, right? Because we know that, especially young males, they tend to lie or exaggerate on the size of things. So you want to ask very objective questions to ascertain that they lie or exaggerate. So we did that in wave 2, and in wave 3, we asked questions about beliefs and network size. So here are the high-level results. So in 2016, we found that 64% of the Canadian population were aware of Bitcoin, and there was about 2.9% of ownership. The top stated reason for ownership was I was interested in new technologies, 29%. Investment was 12%. We asked them, well, what's your top reason for not owning Bitcoin? 28% said, we don't really know much about it, and 32% said, don't really need it. Fast forward another year later, in 2017, when the price has increased, awareness has reached 85%, it's 5% ownership. What's the top reason? It's no longer for new technologies, it's because it's an investment. And there's insufficient, what's the top reason for non-ownership? Stays roughly the same. So this is where the governor has to go on TV and newspapers and tell people, Bitcoin is not a currency, it's an investment, but it's very risky, so you should really understand the risks. So, like all surveys, people are very skeptical, so this is where the knowledge questions come in. So we ask 5 questions about features of Bitcoin that if you know what you're doing, you should get right. And so this is a nice cross-check to see if the survey data is working well. And you can see that the owners are blue, the non-owners are red. The owners, on average, tend to get better scores than the non-owners. Again, it's not a perfect ability to check on our survey. In the interest of time, I didn't show the other one, but if you want, I can discuss how we do it from a survey methodology point of view. We validate survey data versus the network data, and how we have a population estimate where we can aggregate out. Okay, so now just drilling down into the investment reasons, right? We know it's increased from high-level results, right? From 2016 to 2017, the store value has increased from 12 to 58%, where payment-related reasons has decreased from 39 to 10%. The reasons for trust and privacy has fallen a bit, and then this interest level for technology has decreased from 36 to 15%. So this was my favorite question. So you know, and if people think that Bitcoin and cash are substitutes, all right, let's ask this question. Let's ask everyone in that survey, how much cash do you hold? And we did this, and on average, we found that Bitcoin adopters, people who stated they had Bitcoin, said they had $484 in cash. So this is a very skewed distribution, so we report the median, which is 100. Then we looked at the non-adopters, so those who stated that they did not have Bitcoin. And it's $82 on average and $40 at the median. And so I don't trust myself, I don't trust my fellow Canadians to answer the question correctly. So what I try to do is I try to validate it with another survey that we've spent a lot of money on and done a lot of analysis. And this is the 2013 method of payment survey. So again, this is a diary where we ask people very innocuously, just report all your payments over a 3-day period. And it's a very large sample size. And again, I always recuse myself from doing these calculations because I know there's always this urge to keep cutting the data together. Right? So I always give a strict protocol to the research assistant and say, do not deviate from this. You're to follow this protocol, calculate this sample average and sample median, and then after that report it. And this is what we got. So it's $84 as a mean and $40 as a median. So you can see that when we focus on just cash users, the population, we found that it's very similar to the non-adopters. So our survey basically states that these respondents who state that they have Bitcoin also report holding a lot of cash. So this is like an open puzzle to me. You can tell a lot of different stories. If you want to educate me on why this may be the case, that would be great. Or if you can tell me why I'm wrong, that's helpful too. And then we do some classification where we basically, when people ask reasons why they use Bitcoins for transactions, you can see that the classification where people who say they use Bitcoin to send money, they hold a lot of cash, 809 on average and 128 in the median. And then those who don't use Bitcoin to send money, it's about $400 as a mean, and $70 as a median. Okay, so then we ask this question, will Bitcoin be around in 15 years? So what we do is we ask all the participants to state what they thought from a range from 0 to 100% of the probability of Bitcoin surviving in 15 years. So this graph has what we call a cumulative distribution function, and over the survival rates, blue is for the owners, red is for the non-owners. So if you just look at the 50-50 probability, which is at the middle, and you just draw a vertical line, you'll see that the owners have a much more optimistic view, right? More than half of them, right? Or sorry, more than 80% of them believe that the survival probability is greater than 50%. Whereas the non-owners, right, you see that sharp inflection, about half of them believe that it's not going to survive. Have a greater probability of 50% that it won't be around for 50 years. So there's differences in beliefs right, between the owners and non-owners. What we're going to do in more analysis is to look at this price expectations. What we did in this survey was we asked simple questions such as, what is the price of Bitcoin today? And I don't have the graph, but it's very stark. You would think that this is an online survey. You ask the question, what is the price? You think people would be able to do a quick Google or something. But you can see a huge price variation. And once you start drilling down into that, you can see that the owners, the people who are have a high knowledge score, their price dispersion is very small. But then we also have another question where we look at the price expectation in 1 month, and you can see that there's a lot of optimism. So let me summarize. There's high awareness, low ownership. Investment now is the top reason for holding the Bitcoin. Bitcoin holders also hold more cash, and there's this group of people who hold Bitcoin and those who don't hold Bitcoin. They're very different, and so that we need some more analysis. So go back to one of my favorite movies from the 90s. Everybody remember the Matrix?
Oh, yeah.
Red pill, blue pill. So that's what one of our projects we're going to start doing is, again, we don't believe people, we don't believe the survey. So how we're going to do this is we're going to conduct a red pill, blue pill exercise. Where we're going to, in the fourth wave, we're going to match the survey questions with the network analysis. And that's going to be via, well, please don't tell them, we're going to give them a red pill or a blue pill. We're going to give them we're going to give them a Bitcoin. And then we're going to follow them around that network. So that's all I have to say. Thank you.
Red one looks good to me. But let's see what's happening in the investment community. And I think we have from Mavatar, we have Susan, who is going to share with us some insights.
Thank you. Thanks for having me. Okay, it's great to be here and have a voice. I'm pretty useless without my grandma glasses, but okay, it's listen to okay, the video doesn't work. It's fine. It's supposed to be pretty impressive. Anyway, glad to be here, and I really appreciate this opportunity to give entrepreneur side of this story voice. First of all, I would like to pose this question to the great audience of this conference. How many of you have been involved in an ICO or are involved in an ICO today? Okay, great. So, this is practically correlates with the ratio of theory versus practice. And it correlates definitely with the information that I, as an entrepreneur, need to absorb on an everyday basis, coming from my legal and accounting arm, compared to the focus and energy that I should put on innovation and to run the company. And definitely correlates with the billable hours of my legal and accounting compared to the cost of engineering. And this is something that I would like to focus on because I believe this kind of think tank are very, very important and such an early on for giving a chance for innovation to survive. I needed to get some training. So I guess use the traditional keyboard. Startups, I'm gonna, as I told you, I'm gonna talk about what are the implications of ICO integration with blockchain and trying to be a part of this innovative process. If you look at the ICOs, you see that among those 1,300 some ICOs that we had last year, we raised about $5.6 billion in 2017, and there were 435 successful projects that raised in average about $12.7 million. And there are some outliers. 10 largest projects raised 25% of that money, and in average about 1,300% return on initial investment in terms of dollar amount. And majority of these gains came from early projects, and you see that right now, especially after SEC's position, not completely defined position, but at least introducing some concern. The rate of the ICOs actually went down, and the return also will be definitely affected, as we've seen in the last couple months. There were two reasons for this rate to go down. One was, especially in U.S., the SEC position, as well as the price of the value of the tokens, Bitcoin and Ether. But whatever it is, we as entrepreneurs now dealing with that downturn. So who are really, to me, and a lot of the entrepreneurs who have been involved in this process, when we look at the best candidates or best beneficiaries of these ICOs, if you look at the categories of the products and technologies and companies who are doing that, you've seen a great opportunity for female entrepreneurs to raise funds for their companies, and I tell you why that's the case. Disruptive technologies definitely were the real beneficiaries of the ICOs, and we know that there are bad actors and there are lemons, but in overall, you've seen that a lot of innovative projects got funded throughout this paradigm shift. And the missing middle that I'm going to talk about, the companies who raised a little bit of angel investment, but they couldn't really meet the metrics of the VCs to grow, and especially platforms, very innovative products that are serving an ecosystem, and for getting to the phase that they can prove their value, they needed money that they couldn't raise. And we're going through all of them one by one. Again, this is a little bit of some data that we discussed in the previous slide, but what is important here, when you look at the rate of failures or success of these ICOs, you see it really correlates with if it's not better, it correlates with the rate of failure or success of VC-funded startups. Usually 30% of the startups in the first year, they go belly up after getting even funded by VCs and traditional investors, and 50% of them during the first 5 years, and 66% during the first 10 years. So having 48% of the ICOs being successful in the last year might be a good news that we should notice. And also $5.6 billion raised in ICOs versus $71 billion in the VC investment. So you see, if there is a risk of wasting money and investment, there's a higher risk in the traditional investment world. So I would like to bring your attention to this. This is really familiar, Crossing the Chasm, by a great professor in Stanford, Jeff Moore. So if you look at the ICOs in terms of itself, as an innovative product, we haven't crossed the chasm yet. We are about to get the attention. We're actually towards getting the attention of early adopters. And when we get to the point that Wall Street can notice that and get involved, then we definitely cross the chasm. But we don't see that yet. However, this diagram also works for innovative products. I told you that disruptive technologies. Let's start with the female entrepreneurs, and I want to share this story. If you look at the traditional investment, you see that usually investors are investing on the companies that they can actually define with the previous metrics of their portfolio data. Also, they invest on the entrepreneurs that they look like them, or they act or operate like them, and the technologies that they are familiar with. And this is really normal. You have some knowledge, and based on that knowledge, you make decisions. So they process information, and that's how they make those decisions. If you look at the VC industry, you see only 7% of the investors or VC partners are women. So it's easy to understand, why female entrepreneurs are not getting that much of attention from the VC industries, and they're always having a hard time proving themselves. We really have to prove much harder than our male counterparts to convince a VC to invest on us. The second one was disruptive technologies, and this is basically the life of innovation that an innovative product has to pay to get to an inflection point. So for innovative products, it's important to bring the innovators in, and that's not easy. And then get to the early adopters, and then cross the chasm. I borrowed this slide from a good friend of mine, Skylar Fernandez, VC and private equity investors, from his TEDx presentation, and I think that really helps to know why the innovative products and technologies have problem raising funds through traditional investment industry, why the ICOs can really help the innovative products to grow on a timely manner. There's this much of investors that, or funds that, or actually angel investors or microfinance opportunities for companies who are starting startups. And then we have the angel investment and some crowdfunding means that are bringing about $1 million investment to the companies. That part is the traditional VC industry. When you need more than $3 million and they're all ready to write a big check. Usually investors would like to write a $10 million check, but for between that, you see that there are not that many. Actually, that green part doesn't show here. Basically, this part are the funds and investment institutions that can fund the innovation. And if you look at that, the previous slide on the crossing the chasm, that's exactly where you need money to grow. So you have created your product, you put together the team, you proved you prove that this product is working and it's solving a problem, but you need money for market adoption, and that's the part that there are not that many investors to find it. Because when you go to VCs at that point, they're asking you to meet a lot of metrics. First, as an entrepreneur, when you go to a VC, they said, this is a great idea, but come back when you have a prototype. You come up with prototype, raising money from family and friends, and small loans and so on. And they said that, oh well, that's great, but you really need to build a team. So you go through angel investors that they resonate with that technology or and you get about $1 million, and then you go back to VCs again, and they say that this is great, and it seems that you put together a great team, but you really need to show me some metrics that the market will adopt this. Bring me users, bring me some, basically, show me the users, the number of the users. You go back and, with putting your house in loan or whatever, the bank loan, you get that money and you buy some users, organic users versus or unorganic or whatever, and then you come back to them and say that, that's great, you got those innovators or previous, before the early adopters who adopted this technology, but we really want to know if you can retain that users. And then you spend some more time to retain the users and bring the data back and say, this is great, but now you have to have customers, someone who really wants to pay for this product. You bring the customers, they ask you for pipeline. So it goes over and over and over again. And by the time you're meeting all those metrics, then yeah, they can give you a check, but you may not even need that, or you might have failed and died throughout that process. So you become either the anti-portfolio of those investors, or you're completely out of, and you see that 60% of those investments and those companies are dying in the first 5 years. So that's exactly where the ICO can really fail. So there's a void up there. There is something that we don't have. So the VCs shouldn't be really scared and have a fear about ICOs, because ICOs are not competing with them. In fact, And also these small businesses are really important because, as you can see, there are 50% of our GDPs is coming from these startups and small businesses, and 65% of the new jobs are basically created by these small businesses. So it's very important to really feed and fund that missing middle in terms of survival of innovation as well as economic value that has. So what happens when an ICO starts? ICO practically is bringing wisdom of the room, wisdom of the crowd to an innovative product. For a product to be able to cross the chasm again, you need early adopters. If you look at the community behind many of these ICOs, 1,300 ICOs that last year, you see 90% of them are developers. There are some big funds, and now we see hedge funds and so on, but traditionally before in 2016, 17, and 18, you see these investors have been developers who are poking the GitHub of a product, who are sending feedback on the code to the entrepreneurs. They are part of the innovation, and they're helping those startups to basically find the direction of the product. So those early adopters that are needed for crossing the chasm are the investors. And what's wrong with having them, letting them to have a share in the upside of that entire life of innovation? And so what happens? They are putting small bits, right? It's not like gambling. Usually they don't sell their house to participate in an ICO. Well, I mean, talking of that, talking of regulations of the coupons and gambling, right? If you really want to regulate something, we should look at those kind of industries and marketplaces. But here they're putting a small bit, but in aggregate, all those small funds move the needle, and they are really involved in the innovative part of the products. In fact, we should allow them to be part of this. And now, in return, when the ICO and the startup becomes successful and that innovative product gets to the growth part, the share of the proceeds gets back to them. So, and why it's important to not to try regulate those people to invest like we did in the United States. We got to the point that any ICO of a company which is based in the United States, we got to the point that we really can't have developers to participate in our ICOs. They have to be verified. They have to be accredited investor, right? So it means that they should have at least $1 million personal worth, and even the funds that are participating, now we have to do that verification on their partners. So during the past 6 months, I can see, as an entrepreneur who has been involved in an ICO, I can see how this entire paradigm shift and I can't even say it's regulated. They are not defined regulation. It's just fear factors and all of these narratives that are all around, and make my lawyers to come back to me and says that, I don't think you should exclude the U.S. investors in this ICO, and only if you want to work with only accredited investors you can. But if you don't, you may get subpoenaed by SEC. You may, you may have to spend even more on cleaning up that mess. So naturally, I become more conservative, and I completely exclude that development community, right? I'm working with accredited investors in United States. For the also international investors also, they recommended that we should try to work with accredited investors. In fact, there are many countries that these accredited investor definition is not even defined yet. So when I ask my lawyers what that means, that I have to, comply with all the international rules of definition of accredited investors, they told me, well, nothing may happen. SEC is not that concerned about you screwing someone who's not an accredited investor internationally, but 10 years from now, you may be in a Malaysia airport to get your connection flight to somewhere else, and you may get arrested because you haven't complied with the accredited investors regulations in that specific country. So you see that this, now instead of focusing on technology and problem solving, which my technology platform is supposed to do, now I'm more concerned about what may happen to me 10 years from now. This is really counterproductive in terms of the innovation innovative life of a product. So these are some of the, I'm practically crying on your shoulders because I know if this room goes out and try to figure out a way for all of this unnecessary conservatism to stop, then we can work more. So all I'm saying is that wisdom of the crowd is needed, and we should probably early on define regulations that make me as an entrepreneur comfortable to bring those partners in, instead of going door to door to practically about 100 VCs. That's what you can do before dying or becoming an anti-portfolio of an investment firm, right? 100 VCs is all you can do as an entrepreneur. Go and present to them and see if you can get funded. Versus 50 million developers who can give you thumbs up or thumbs down right early on before you spend your life. In my example, 7 years of my life on creating a technology. So we really need to make sure that we don't exclude them in such an early on. So let's talk about the definitions of the tokens, because the ICOs, I think we covered them a little bit, and I'd be happy to share our experience with you after the panel. But let's talk about the tokens and a definition or the type of the tokens that we're talking about. Right now, the narratives are all about security versus commodity. And utility token doesn't get that much of attention, which was really important at the beginning. Last year, it was all about utility. Everyone was trying, when they were doing their ICO and releasing their cryptocurrency, they were trying to somehow find a utility to their token. But now that that option is kind of off the table, and there are two preliminary categories defined and becoming kosher by SEC, that utility token is not talked about that much, which that part is probably the most important part that we need to define as soon as possible. And what these utility tokens are. Utility tokens basically are the tokens that are used for a service or unit of service that can be purchased by these tokens. And if you want to compare them, we can compare them in technology and technology world to API keys, right? I mean, if you need to use this software, you need to have an API. And that's how we define the utility tokens, and I think it's important for policymakers to look at the utility of these tokens. And so let me talk about the utility token and give an example that may help you to find more basically, because if we can find best practices and if we can define and find a few good utility tokens, it would be easier to define them. We created a software in my company for monetization of influence. The products that are sold around us They are influenced by media, by our cousins, by social media bloggers, and all of these guys. And in fact, it's a system for user-generated advertising, and giving them a share for influencing the product sales. So for 7 years, we going through the very extensive R&D, we created this platform that can practically track the influence of an influencers to the product sales and get them rewarded by traditional commission. However, the traditional affiliate sales model and industry is very ineffective and poor because it can be skewed. It can be that influence basically it can be skewed, and the money goes to the publishers or influencers who really didn't have that much of say in that sales. We created that. We went to retailers and we said that we can extend your sales force to millions of people. This is an Uber for retail sales. And we were so happy to share that news with them because they're all suffering and they want to compete with Amazon. And we're practically making the world around us shoppable and track every product to online or offline in stores. And we give a share of that product sales to people who created that shoppable content. So they look at it and they said that this is great, but who wants to take care of the accounting part of it? Who wants to send these millions of checks for these new type of salespeople? We didn't have an answer. I mean, sending a check for someone to give them a commission of 25 cents for selling a $5 product, it can cost a retailer $15 to $20. So we didn't have an answer. It means millions of dollars, 7 years of my work and my 50 developers behind this platform was all going to waste. However, thinking about cryptocurrency and blockchain that we integrated actually as of last year and we're ready to release our token in May, completely remove that bottleneck. So there is no accounting. The influencers selling something, we track that sells to the checkout page of any retailers, and then the retailers are buying the cryptocurrency, they deposit it in their wallet, and every time that transaction is done, we get the commission, translate that dollar to cryptocurrency, and deposit it back in the wallet of influencers, right? How we could do that without cryptocurrency? So that's the true meaning of a utility token, and there are many of these good examples, especially every time that we're talking about the technology that has anything to do with sharing economy, user-generated content or data. That's something that definitely can help. Micro payments are the best applications of these utility tokens. And I know that I don't have that much of time, so if you have any more questions, I'd be happy to answer.
Thank you. And Susan, we know no regulation is better than having regulation for sure. I want to thank everybody
Some is good.
today. And we have just a moment for one question, given the fact that we are on a tight schedule and we have an upcoming session number 2. Is there just one and only one question from the audience that you can address to directly to any member of the panel here? No, I guess we learned a lot. We thank you, all of you, and